So no outperformance by the Indian market this year then?
Well, we've had a really strong run in equity markets in India. So while they might continue to go up, over the long run it probably will. But to see 15% compounded return over the next 3 to 5 years is going to be challenging given the current valuations in equity markets.
How concerned are you that we're seeing outflows? Foreign investors have been pulling money out for the last 3 weeks, and some are talking about a rotation. Is that worrying you at all?
Well, from India perspective, I think it's a really great long-term story, so I won't worry about the last 3 weeks. Our entire focus is on actually Indian private credit markets, which is in very early stages of inflows, and will continue to see that growing at a compounded rate over the next 5 to 10 years. So that's why our focus is just building the blocks so we can try and take advantage of that. Also, the penetration in household sector of fixed income instruments, including amongst the high net worth individuals, private credit market is very low. So we expect that to increase. India is, I think, the new US in terms of how the industry grows. We have a long way to go from here.
Ronnie, I mean, really, it is perhaps a financial imperative it's turning into the private credit market there. As you've mentioned, it's relatively in its nascency. How do you see, and where do you see opportunities? They seem to be thrown up in all kind of different industry groups currently.
Yeah, sure. So, obviously the banking sector is allowed to lend to a certain sector, and then there's the rest of the non-bank sector that used to plug that gap. The non-bank finance sector has been under pressure in terms of deleveraging post the 2018 IL&FS issue, and therefore the gap has opened up both from a pricing perspective in terms of attractiveness for the private credit sector. So there are mainly 4 places where I think private credit, at least performing private credit sector, would plug the gap. Firstly, it's in acquisition finance. Secondly, it's in growth capital. Thirdly, it's in buyouts. And fourthly, it's in flexible financing for very quick turnaround time in terms of opcos. So in those 4 sectors, we see a huge opportunity, and the engine has just started to getting warmed up.
Yeah, but you need some petrol, don't you? How easy or how difficult is it to raise funds, and what are you raising money for right now in terms of investing?
Sure. So, in terms of demand, it's obviously huge. We've seen, for example, in the last 6 months of our existence in India from the launch date, around 100 incoming deals. We've invested only 3 so far. So I don't think there's any dearth of opportunities set to invest. You have to find the right ones. In terms of fundraising, which is obviously, like I said, only 0.5% of India's GDP is currently in private credit markets. The number in the US is closer to 5%. So I think there's a huge amount of growth to come from. As I talk to many family offices and high net worth individuals in India, I find that they have very little allocation of the personal wealth there. So that's going to, obviously start moving as equity markets probably top out around here. Also, from an offshore investor's perspective, as we talk to offshore investors, many are, as you know and as you've reported, are very much entrenched in the US private credit markets, where they see close to double-digit returns in the current interest rate scenario. But the interest rate scenario in the US is going to change. And we probably see a topping out of rates here and rates lower. In that scenario, Indian private credit at 15% kind of yield for performing sector is very attractive, especially with the fact that, I don't think the Indian rupee is going to depreciate like it did in the past. So if you even cover for the rupee depreciation, you still get, early teens kind of return for performing credit, and you kind of push the envelope a little bit more. You might even get higher. But even if you stay in the very safer sector, on a dollar basis, on a gross yield basis, you'll get 12, 13% kind of returns, which is very difficult to get out of any other asset class.
Ronnie, even as we talk about opportunities, people are talking about looming risks. How are you assessing that? Because, you know, we're beginning to see tighter regulations from SEBI, for instance, expressing some concerns.
Yeah, that's a great question. You know, I think the risks are actually trying to protect the industry. So, you know, in the past, we used to see a lot of private credit being you know, deployed by levered non-bank finance companies, kind of bypassing the fact that if banks can't lend, the non-bank finance companies, sometimes, you know, even sponsored by banks, would lend. And banks would in turn lend to the NBFCs, and the NBFCs would on lend. I think this circularity is what regulators are trying to gradually, you know, mitigate to protect the system. So as we've seen in the West, disintermediation of credit happens when asset management companies grow, and large institutions, whether pensions or endowments, family offices, insurance companies, etc., start investing into asset management company products, and that's going to happen in India as well. So we're just starting the early stages of that. There's only around 15 billion of capital deployed by Indian asset managers in the private credit space. It's just about to start.